right. Hi, everyone, and thanks for tuning in to the third of our Milk Chocolate webinar series this evening. My name's Jack Bailey, and I'm the Growth Manager here at Milk Chocolate. And tonight I'm joined by the two other gentlemen that you'll see on your screens. The first being my colleague and the co-founder of Milk Chocolate, Michael Cleary, and our special guest for the evening, Dean Crossingham, who holds the title of Head of Taxation at Stanford Brown, who are one of our preferred professional service partners here at Milk Chocolate. Throughout the next hour, Dean will be presenting on what has been one of the most contentious issues that arisen from the most recent budget, being the proposed tax reforms for Australians living abroad and what it might mean for those looking to purchase property back home. We'll aim to do a Q&A session at the end, time permitting. So if you have any questions that arise throughout, please don't hesitate in popping them into the Q&A box down in the corner. I'll also keep an eye on that box throughout for any questions that are relevant to the topic at hand that may be being discussed. And Dean, I do apologise in advance if I interject and ask some at certain points. And look, we may not get a chance to answer all your questions, but we will endeavour to do so to the best of our abilities. Now, before launching into this evening's proceedings, as always, there's just a few housekeeping matters that I will just quickly address. First and foremost, and probably most importantly, any advice given throughout this webinar is strictly advice of a general nature. Secondly, as mentioned above, we welcome any and all questions. It is quite a complex issue, and if we can't answer them all at the end whilst we're conducting our Q&A, we'll get back to you personally after the webinar. Thirdly, this webinar is being recorded and will be available for you to watch and digest in hopefully under 24 hours. I'll send out an email link once the upload is complete. And lastly, within the accompanying email, I'll include Dean's contact details if you wanted to touch base to discuss further what was covered in tonight's webinar. So I'll now pass over to Michael, who'll give a quick introduction on himself before then introducing Dean, where we'll then get stuck into the nuts and bolts of the subject at hand this evening.
Awesome. Well, thank you very much, Jack. So it's really nice to welcome everyone tonight. Thanks for tuning in. And for those of you that don't know me or know about Milk Chocolate, as Jack mentioned, my name is Michael and I'm one of the co-founders. And at Milk Chocolate, we plan, purchase, construct and manage property in Australia for Australian expats. So obviously this topic is very close to our hearts. I'm really looking forward to Dean unpacking the proposed changes. And with almost 20 years of experience under his belt, Dean is well placed to really share the facts to the expat community and let everyone know, what these proposed changes could mean. So on that note, we'll get started.
Fantastic. So do I share my screen here, Jack?
Most certainly, Dean. Just give me 1 second whilst I change those permissions.
Sure. Well, thank you for the warm introduction, guys. And I'm really looking forward to talking about these proposed rules. Allow me to click a few buttons here. Okay, perfect. I trust you can all see my slides. Okay, perfect. So yes, really looking forward to talking about these proposed rules. It's just a great opportunity to explain what is actually going on to the expat community and give them some clarity on what these rule changes mean for them. So the first thing that I would like to jump into is just the current status of these changes, including the journey that we've been on to get here and if and when these changes are going to commence. And what I think is relevant here is that these proposed rule changes have undergone a very long process and it's been independent of the government to reach the current point of where they are now. So for example, I've heard things that it's just a cash grab by the government. Expats are going to be paying double tax and we need to lobby against the government because our voices haven't been heard. So what I can say about all those statements is that they couldn't be further from the truth. So this whole thing commenced with 3 projects conducted by the Board of Taxation in 2017, 2018 and 2019. And this board is independent from the government and independent from the ATO. Now, the board looked into our current residency rules, which were legislated back in 1930, and they consulted extensively with industry to reach a conclusion that the current rules are no longer fit for purpose. A lot has changed since 1930. So off the back of that, the board, in collaboration with industry, proposed a new set of rules that better fit our modern era. Now, we move into 2021 and the government has picked up on what the board has been doing and has now made reference to these proposed rules in the recent May 2021 budget papers. And these papers say that these changes to residency laws will be implemented with effect from the first income year after they've been made into legislation. So if we see law being passed before 30 June 2022, these changes will have effect from the FY23 Australian tax year. So the FY23 Australian tax year.
Sorry, Dean, just a quick question on that. So, and I know we're going to talk about this in a little bit more detail when it comes to people owning property in Australia, but if these laws are introduced and they did come into FY23, would that mean that, that they would, that any, that people owning property in Australia, they would have that grandfathered and they wouldn't need to, they would need to be conscious of these particular rules, or would it just apply, because would it just apply ongoing?
Yeah, so as far as any grandfathering terms, what's proposed by the Board of Taxation is that these rules only apply prospectively. So we won't be looking at historic or retrospective years being affected by these proposed rule changes. So that is as far as the grandfathering has been suggested by the Board of Taxation.
Sure, no worries.
Okay, good question. So the process from here, well, first thing that needs to happen is we need to see some draft legislation. So we don't even know exactly what these laws are going to look like yet. So all we have are some reports done by the Board of Taxation in 2019. So no actual laws from the government just yet. And that will have to be a bill that goes through Parliament. And it's worth knowing that 10% of bills that enter Parliament don't pass, they fail. Okay, so there's a 10% chance that even if we see a bill and even if they're entered into Parliament, that they won't be successful. So the point of all this is that it's been a very long process that started way back in 2017. It was instigated by a body that's independent of the government. We need to improve our laws because they don't practically work very well anymore. And now that the government has carriage of the matter, there are still a few critical steps to go before these proposed changes become real. So what I think is really crucial to cover off next in this webinar, before we even go into any of the details of these rules, is just how our existing tax treaties are going to operate in light of these proposed changes. Now, our tax treaties really haven't been given much attention in the overall conversation so far, and that is a bit odd because they're really, really important. So for those that aren't familiar with what a tax treaty is, it's basically a set of rules that harmonizes the taxation between two different countries. So if a taxpayer does interact with both countries, that taxpayer doesn't get a conflicting outcome between the two different domestic tax laws. So I'll tell you right now why these tax treaties are going to be so important under the proposed changes. And that's because if you're living in a country that has a tax treaty with Australia, and under that tax treaty, you're a resident of that other country, then the Board of Taxation has proposed that these changes will not apply to you. Okay, and that's probably one of the most important things that I'll be saying on this call, so it's worth repeating. If you're living in a country that has a tax treaty with Australia, and under that tax treaty, you are a resident of that other country, then it is intended that these rule changes do not apply to you. So if you're dialing in, for example, from New Zealand, Singapore, Japan, China, India, the list goes on. There's over 50 different countries that Australia has tax treaties from, US, Canada, Malaysia, Singapore, then these proposed changes to tax residency rules should not have any impact on you. Okay, and that's why these tax treaties are going to be so important if and when these rules are changed. Okay. So given the importance of these tax treaties, I think it's worth diving in just a little deeper to understand how the residency rules under a treaty operates. Well, if you're a tax resident of Australia under our domestic tax laws, and if you're also a tax resident of another country under their domestic tax laws, the tax treaty says you can only be a resident of one country, and that is the country where your permanent home is. But the tax treaty then goes on to say, well, if you have a permanent home in both countries or in neither countries, you're instead a resident in the country where your personal and economic relations are closer. So it looks at where your home is, and failing that, basically where your friends, family, work, and assets are. Okay. And our tax treaties are all largely based on the OECD model. So again, if we look at all the 50 countries that we have tax treaties with, they basically all look the same as this. Okay. So what is a permanent home? Well, it's any form of home can be taken into account. It can be in a house, it can be an apartment, owned or rented. It can even be a single furnished room in a larger dwelling. but the permanency of that home is what is essential. So it has to be available to you at all times, and not just for a short duration. It has to be where you eat, sleep, and it's where you live, and of course contains all your personal effects. So that is what the permanent home is in our tax treaties, and tax treaties are very important going forward, and they should be the first thing that an Australian expat considers when looking at these proposed rule changes.
And sorry, Dean, just on that, is there a quite an easily accessible site where we can look at those treaties, just for those wondering?
Okay, well, gee, I'm not sure if it's quite easily accessible, even understandable without a tax background. I reference them from the ATO legal database. That may be a relevant site, and we could circulate that link afterwards if necessary. But that's the reference I use, but I assume they're listed in a lot of places. Yeah.
One of our lovely panelists actually just put it through, so thank you for that.
There you go. Okay, so I think it'd be helpful next if we run through what our current residency laws are, and I'll call out some of the important points which would help us understand what changes are afoot for Australian expats. So under the current laws, there's a three-phase approach in determining tax residency. That is the resides test, the domicile test, and the 183-day test. As for the resides test, you'll be a resident if you reside here, and that's basically a mix of all the ordinary concepts rolled into one. It's not defined in tax law, so as practitioners, we have to rely on 90 years of common law to tell us what that means. So it takes into account your time, intention, and purpose of being in Australia, your family, your business, your employment ties to a particular location, where your assets are, as well as your social and living arrangements. So all these things are wrapped up into the resides test. Now, these resides concepts, these were introduced, as I said, back in 1930 when the legislation was enacted. And at that time, the question as to where one resided was fairly easily established, given that international passenger flights weren't even operating in Australia back in 1930. However, now because of globalization, international working and living arrangements, it's become increasingly difficult to determine where somebody resides based on what the courts have told us the factors to consider are. So this is really part of the grey area of the current laws that the Board of Taxation is proposing that we move away from. So if you don't reside in Australia, you still may be a tax resident if Australia is your domicile. Now, when we start talking about domicile, we talk about your domicile of origin, which is your Australian citizenship, or your domicile of choice, which is permanent residency. So if you're an Australian citizen or PR, you will be a tax resident of Australia under the domicile test. And lastly, we have the 183-day test. So if you're not a tax resident under the resides test or the domicile test, you will be a tax resident if you spend 183 days or more in Australia during an income year. So under the current laws, they've left the simplest and easiest to understand test and put it last. So now there is a carve out that is relevant to the domicile test and the 183-day test that is crucially important to Australian expats at the moment, because even if you are an Australian citizen or PR and you've spent at least 183 days in Australia, you won't be a tax resident if your place of abode is outside Australia. So it mirrors the tax treaties that I've already mentioned. But what is important here is that this place of abode carve out is currently available to those in tax treaty countries and non-tax treaty countries alike. Okay, but going forward, this carve out is going to be removed from those living in non-treaty countries. Okay, so if you're dialing in from a non-treaty country, you're going to have to manage these proposed rule changes that are ahead of us very closely.
Okay. So we would have a lot of our clients would particularly reside in the UAE, and so what thing would that mean for them essentially if they were to spend more than 45 days in the country under the new proposed laws and they owned a property in Australia?
Yeah, absolutely. So firstly, because the UAE isn't a tax treaty country with Australia, these proposed rule changes will apply to them. Now, under the current laws, people residing in the UAE are relying on this place of abode carve out to keep them out of Australia's tax net. That will be removed. And yes, they will be subject to the new laws. And under the new laws, you're right, Michael, there is a 45-day threshold in relation to commencing residency. Now, in addition to that, which I'll go through in a moment, there's a couple of other hoops to jump through before you become tax resident, but that's exactly the thing that the residents of the UAE need to consider.
Thank you.
Okay. So let's jump to exactly what these proposed new laws are that everyone's talking about. So it's expected that the changes will mean that your Australian tax residency is determined by 3 governing rules. So they are the primary rule that affects everyone, a secondary rule relevant only to those inbound individuals commencing their residency, and lastly, another secondary rule relevant only to those outbound individuals who are ceasing their residency. So in terms of the primary rule, the rule is proposed to say that if you spend 183 days or more in Australia in the income year, July to June, you'll be an Australian resident, full stop. Okay, so this is a key departure from the current rules, because in the current rules, the 183-day test is relegated to the end, but under these new rules, it's right at the forefront. So that under these proposed rules, they're prioritising the physical presence criteria as the key determinant to establishing your Australian tax residency. Okay, that's going to be the first test that is applicable to everyone. Now, in terms of the secondary test for the secondary rule for commencing residency, now that's relevant to those inbound individuals who are not already tax residents. So your UAE, people in the UAE. So under these rules, what it says that you will be an Australian tax resident if you have spent 45 days in Australia in an income year and you satisfy 2 of 4 additional factors. And I'll dive into those factors just in a moment. And of course, as we've already seen on this call, this is the area where it's going to have the greatest impact on Australian expats and where all the interest is at the moment. So we're really going to need to monitor that 45-day threshold going forward if you're not in a treaty country. Okay.
And Dean, that for that 45 days, is that consecutively or just across that year at any time?
That's across that year at any time. That's okay, right. So from the 1st of July to 30 June.
So it could be 2 trips of 20 days, for instance, and you'd need to make sure that it didn't encroach 45 days.
In aggregate, that's correct. Yep, absolutely. And in terms of the secondary rule for those outbound individuals who are ceasing their residency, basically the proposed changes will make it harder for you to break your Australian tax residency status. If and when these rules do become law, it's these ceasing residency laws that I think will find the most complications. Yes, the commencing residency rules are strict. The ceasing residency rules are going to be complicated. Okay. Now, you may be an Australian expat thinking, well, I'm already a non-resident of Australia, so I don't have to worry about these ceasing residency rules. And my answer to that is, well, you will do if you trigger the commencing residency rules. So if you enter Australia's tax net, you'll be wanting to get out again. And this is where the ceasing residency rules are going to be just as important to you. So that brings me to the point of highlighting that what the main risk is by triggering the commencing residency rule is that once you're in, it's going to be much harder for you to get out again. Okay. And I'll be going into these ceasing residency rules in detail as well in just a moment. Okay. So just to cover off on the primary test here, which is the 183-day threshold. Now, just by way of example, so what this example here illustrates, I hope everyone can read it properly, is that how the 183-day test will operate differently depending on if you're a resident or a non-resident of Australia in the preceding income year. Okay, so we have 2 characters here. We have Isla and we have Sasha. Isla and Sasha, they're wife and husband, and Isla was an Australian resident in FY23, whereas Sasha was not a resident in FY23. But in FY24, they both spent 184 days in Australia. So that's above the 183-day threshold. So they will both be Australian residents for FY24 under that primary rule. Okay. Now, the slight distinction here is that Isla, because she was a resident in the preceding income year, she'll be taken to be a resident for the entirety of FY24. But because Sasha was not a resident in the preceding year, he will only be a resident from the point when he actually arrived in Australia in FY24. Okay. So this example just begins to emphasize the point that once you are in the case of Isla, it will be harder for you to get out than it currently is. Okay. So now let's get into the proposed commencing residency rule that contains the 45-day threshold and the two-factor test. So to reiterate again, it is proposed that you will be an Australian tax resident if you spend at least 45 days in Australia in an income year and you satisfy two factors, and you'll be a resident from the day of arrival. Okay. And there are 4 factors available that you must satisfy. These factors relate to your right to reside in Australia, your economic connections to Australia, your family being in Australia, and whether you have access to Australian accommodation. And you only need to meet 2 of the 4 factors in addition to being in Australia for at least 45 days. And if so, that is when you will become an Australian tax resident. So I've ordered them here 1 to 4 based on what I expect their impact to be on Australian expats, and I'll go through them one by one. So in respect of the right to reside in Australia, you will satisfy this factor if you have a right to live permanently in Australia for immigration purposes. So for example, citizenship and permanent residency. So it doesn't include transitional or temporary visas. So it echoes that domicile test that I've already spoken about. So if you're an Australian citizen or if you have permanent residency in Australia, you will satisfy this factor. Now, in respect of the Australian economic connections, you'll satisfy this factor if you are employed in Australia, if you actively carry on a business in Australia, or if you own certain Australian assets. Now, it's these certain Australian assets that is the pertinent element here, because at the moment, it includes 3 different types of assets. It includes an Australian bank account if it holds significant cash. Now, we haven't been told what significant is just yet, so we'll wait to see what that means. It includes an interest in an Australian family trust. Now, we haven't been told what they mean by interest just yet either, so we'll wait to find that out. And lastly, and probably most importantly for this call, the final type of asset is Australian real property. So if you own a home or if you own a rental property in Australia, it is proposed that you will satisfy this Australian economic connections factor. Okay. Now, in respect of family in Australia, now this will be satisfied if your spouse or any of your children under 18 years of age live in Australia at any point in an income year. So this includes spouses in all legally recognised relationships, including de facto and same-sex relationships. So by definition, this factor cannot be satisfied by a single individual that doesn't have any dependents.
And just on that, Dean. So if you had had a marriage breakdown and your ex-partner was living in Australia with your children, would they still be considered? Would that still factor into it because they're permanently in Australia, but it's via a marriage breakdown?
So there's a point in time legally where that relationship is severed under the Family Law Act. So after that point, then legally you would not be spouses any longer. So it's a very good question, and it's one of those potentially grey areas that should be explored. But I imagine for tax in other areas, it follows that legally defined area in family law.
And that would include your children as well under 18 that would fall under that are living with your ex-spouse?
Well, your children are probably always legally your dependent anyway
yeah.
Until they pass the age of 18.
Sure. So anyone... Oh, sorry, Jack, you go.
Sorry, Dean. I was just going to say, what about parents? When we talk about spouse and children, I guess, are parents kind of in that family bracket, or is it, I guess, the immediate, consideration there with what you just mentioned?
Yeah, so parents aren't referenced at all in this family in Australia factor. So your parents may live here and not be counted towards this factor at all. And any other relatives. The only family members referred to by the Board of Taxation are spouses and children under the age of 18.
Got it.
Okay. So lastly, there's the final factor, Australian accommodation. Now, this will likely be a lesser exercise factor, but it's worth touching on just for completeness. So you will satisfy the accommodation factor if you have an arrangement to access accommodation at any time during an income year. So if you have property in Australia that's already counted under the economic connections factor, it won't be double counted again. So it's already counted. It won't be included under the Australian accommodation factor. The factor does not include temporary access to family members' home or temporarily staying at hotels or service apartments and so forth. So I don't see it as very relevant at all to Australian expats. So it shouldn't be a concern. Okay.
And Dean, just before you move on from that, we've got a question from someone residing in the UAE who is a pilot, and a very good question. Just that they're flying back to Australia, a lot for their job and spending between 2 and 3 days in layovers. Would those 2 to 3 days each time add up to add to their 45 days?
Well, technically, they probably will. They probably will. That's right. Now, the proposals are put forward by the Board of Taxation. Now, the government may depart from them in any which way when they make the law. So there could be a range of special circumstances that are factored in to not be included in that 45-day threshold. So in 2019, the special circumstances that the Board of Taxation referred to were family illnesses and volcanoes erupting. Okay. Now, if in 2021 the Board of Taxation did this report, I'm sure they would have had COVID. So I'm sure there's also a range of other special circumstances that need to be factored in as well, and that'll be part of the process of that draft legislation getting through Parliament.
Sure. And just one other question too, or from myself, just to really understand. So if someone is here for over 45 days and they are deemed an Australian tax resident, does it in the most simplest form or terms mean that, their global income is then just taxed at Australian rates and they would owe that?
That's correct. That's correct. So from the date of their arrival, their worldwide income will be included in their Australian taxable income. And that income would then need to be reported to the ATO.
Sorry, is that the date of arrival, Dean, or after 45 days?
From date of arrival. So the dark green box on the bottom left, you're a resident from the day of arrival.
Okay, if you meet that.
That's right.
Yeah.
Okay. So what does all this practically mean? So as an expat, we can take for granted that you're either an Australian citizen or a permanent residency, so you'll satisfy that right to reside factor. Now, if you've been in Australia for 45 days or more and you have a significant Australian cash balance, you will be an Australian tax resident. Okay. If you've been in Australia for 45 days or more and you own an Australian property, you will be an Australian tax resident. If you've been in Australia for 45 days or more and you've brought your family here as well, guess what? You'll be an Australian tax resident. So on that point, if you're an expat and you bring your family back with you for greater than 45 days, you can hold as much cash as you want in Australia. You can own as much property as you want in Australia. It won't make any difference to your residency because you'll already be included as a tax resident by virtue of your family being here. Okay. So that's what the commencing residency rules say.
Dean, I might just jump in here. We've got a good question from Dish, and I think this is in relation to the grandfather in question that we had just before. But do you think if there is a chance the new laws, if passed, will be applied retrospectively, e.g. spend 60 days in Australia in FY 21-22, but the new laws came into effect July 2022?
No, I don't think that'll happen at all.
No. Okay.
No. So it'll look forward from the FY23. It'll make inquiry on what happened in FY23 going forward, and it won't have any reflection on the prior years.
And we did just have another good question, just in regards to the second factor. Would super count towards that secondary criteria?
Oh, yeah, good question. But at the moment, it's not listed.
It's not listed? Okay.
It's not listed. Good question. Good question.
Thanks for that, Crystal. That's, a curveball for Dean there, but
yeah.
Okay.
Okay. So now, just to talk about this commencing residency rule as an example. So we have here two characters, Rebel and Yu, and they're both Australian expats. And the distinction here that Rebel returned to Australia for less than 45 days in an income year, whereas Yu was in Australia for greater than 45 days in an income year. Okay, so in the case of Rebel, because she was here for less than 45 days, it doesn't matter what factors she may have satisfied. We don't need to look at them at all, simply because she wasn't here. She was here for less than 45 days. Our inquiry ends and we conclude that she was not a resident for that income year. However, for Hugh, he was in Australia for greater than 45 days. So only then must we look at the factors. We know that Hugh is an Australian citizen and he brought his family here with him. So he satisfies two factors for that income year. So we can conclude that he did commence his Australian tax residency. Now, so what I would like to go into now is the ceasing residency rules. So although these proposed rules are trying to promote simplicity, this is where things are going to get complicated. And as I said, these ceasing residency rules are very important to Australian expats if you have already triggered the commencing residency rules. So the ceasing residency rules are different depending on whether you have been an Australian resident for at least the last 3 preceding years, and if you haven't. So for those that have been an Australian tax resident for the last 3 years, you will be considered a long-term resident. And the default rule is that after you depart Australia, you will continue to be a resident of Australia until you spend less than 45 days per year in Australia for 3 income years. So if you satisfy that condition, you will be a non-resident on the first day of the 3rd income year. Okay, are we getting complicated enough? So that's the proposed default rule. So very obviously under these proposed rules, it is going to get harder to break your Australian tax residency status, and it can take you up to 3 years to do so. And I've got some examples on that to work through as well. Now, there is an exception to that long-term resident rule, and that's the proposed overseas employment rule. And what this exception provides is that instead of waiting until year 3 after you depart from Australia to become a non-resident, you will instead become a non-resident from the day after your departure. Okay, so you can bring that forward to the day after you depart. And the main conditions of the overseas employment rule is that your overseas employment contract must have a mandated term of greater than 2 years, and you must have accommodation in that country, plus you don't return to Australia for 45 days or more in each income year. Now, the 45-day condition, you will have control over that, so that can be managed. The accommodation available condition, again, that should be easy enough to satisfy, but the difficult condition here, I expect, will be that mandated term of greater than 2 years in your contract if you are looking to bring forward your ceasing residency date to the day after your departure. So look, it'd be interesting to know if anyone on the call has something like that in their current contract, or if they've even seen or heard of that happening. That would be really interesting to hear about. Now, looking forward, it would be good to see how the market responds to this overseas employment rule. Employees in non-treaty countries, because again, these rules won't apply if there's a tax treaty, so it's only the non-tax treaty countries that we're talking about here. Those employees in non-treaty countries will likely want to stay competitive to attract the best Aussie talent. So I can only imagine if these rules do come into effect, we may begin to see some complying contracts becoming more commonplace. So the second category here is that under the ceasing residency rule is for those that have not been in Australia for the last 3 years. So you'll be considered short-term residents, and this is applicable to those expats who have currently been overseas as non-residents for the last 3 years. Now, the conditions for this ceasing residency for a short-term resident is that you must spend less than 45 days in Australia in an income year, and you satisfy less than 2 factors. So again, the factors come into play again, but only relevant under those rules for short-term residents. So as you can see on the slides, the factors, they're not relevant for long-term residents. Now, if you're a short-term resident and you satisfy these conditions, your residency of Australia will cease from the day after your departure. So similar, you won't have to wait that 3 years if you're a short-term resident and you cease your tax residency. Now, so on face value, these ceasing residency rules, they do seem fairly well defined, but if and when they do become law, I expect in practice, this is where all the complications are going to be. So if you're an Australian expat at the moment and you do trigger the commencing residency rules, you're going to have to be very aware of what these ceasing rules are and what they mean to you. So let me run through a few examples. So to demonstrate the long-term resident rule in an example, we have here Russell. Now, Russell is a long-term resident of Australia, and he's lived here for at least the last 3 income years. And in FY23, Russell decides to move overseas, but he will frequently return back to Australia for short visits. Now, because Russell is a long-term resident, we don't need to inquire about the factors, whether he does or doesn't satisfy any factors. We just need to look at how many days he spends in Australia, and his residency will cease as soon as he has had 3 consecutive years of being in Australia for less than 45 days. So we can see here that in FY23, being the year of his departure, he was in Australia for 215 days. So he'll be a resident under that primary rule, the 183-day test. Now, in FY24, he actually spent greater than 45 days in Australia, so he's still a resident for that year as well. We then need to look at 25, FY26, and FY27, where for each of those years, he was in Australia for less than 45 days. So therefore, he will be a non-resident at the commencement of FY27, being at the start of the 3rd consecutive year. Okay, so much harder for a long-term resident to exit from Australia.
So something to really, as you said before, to consider when thinking about taking a job overseas, and what countries do have those tax treaties in place.
Absolutely, absolutely. So I have an example now of a short-term resident who actually converts to a long-term resident under the ceasing residency rule. And this example is very applicable to Australian expats who are Australian citizens or PRs, and they own an Australian property and or have family that move between countries with them. So Nicole, she's an Australian citizen and she owns an Australian property, but has not been in Australia for the last 3 years. So the short-term resident rules apply to her. In FY23, she returns to Australia and stays here for 100 days. So under the commencing residency rules, she has been here for at least 45 days, and she satisfies at least 2 factors, being the right to reside in Australia by virtue of her citizenship, and the Australian economic connection factor by virtue of her owning Australian property. Now, in order for Nicole to break her residency with Australia in FY24 and FY25, under the short-term resident rule, she has to do 2 things. She has to be in Australia for less than 45 days, and she has to satisfy less than 2 factors. So for all those 3 years, 23, 24, 25, because she continues to be an Australian citizen and because she continues to own her Australian property, she doesn't pass that ceasing residency test, even though for FY25, she's here for less than 45 days. So Nicole now gets to FY27 and is still a resident. However, by FY27, she has now spent 3 years as an Australian resident. So she's now a long-term resident, and she has also been in Australia for less than 45 days for the last 3 income years, so FY25, FY26, and FY27. Now, under the long-term resident rule, she now qualifies as a non-resident of Australia, and that would be effective from the first day of FY27. So Nicole got caught in the Australian tax net in the first year, but then basically took her 4 years before she could get out again from the Australian tax net. And that's the duration of time that is going to be the cost consideration for Australian expats if they are contemplating breaching that 45-day threshold in year 1.
Thank you. So, I mean, there's a lot of, quite a few, it's fairly complex, isn't it? So, I mean, it is a really, it's really important that people are across this and, and they are seeking that advice, because it is a very complex, very complex in the way that it's worked out.
Oh, it certainly is. So complex it is. I've tried to make an extra point here of just summarizing it even further. So this is where we get to the pointy end, and this is the crux of the matter for Australian expats. And this is a summary of the preceding points that we've discussed so far. So for Australian expats who have been out of Australia for at least 3 years, the proposed commencing and ceasing residency rules, they actually play out the same if you take a close look. So the first thing that you need to consider is, does a tax treaty apply? And under that tax treaty, are you a resident of that other country? Because if so, you shouldn't have to worry about any of these things. Now, if a tax treaty does not apply, you now have to manage yourself very carefully in respect to that 45-day rule. And if you intend to stay in Australia for greater than 45 days in an income year, will you satisfy at least 2 of those factors? Because the consequences are that in year 1, you'll be a tax resident from the day you arrive in Australia, and you will now be in Australia's tax net. And the only way that you can exit for at least the 2 years is for you to satisfy less than 2 factors, okay, and be here for less than 45 days. So if you're an Australian resident, citizen, or PR who owns property, the reality of the proposed rule is that you'll actually be an Australian tax resident for year 2 as well, because you'll be keeping 2 factors qualified for. And then the only way you can escape Australia's tax net under the proposed rules is if by year 3 you have spent less than 45 days in Australia for each of year 1, year 2, year 3, because by that point you'll be a long-term resident and you'll be eligible for non-residency. Okay, so under the proposed rules, without doubt, there's very significant tax consequences if you do recommence your Australian tax residency. However, the positive news in all this is that at least the proposed rules provide a very clear set of parameters that Australian expats can manage their circumstances accordingly. So we know what the rules are and we know what behaviours we have to take to get the desired outcome, be that non-residency or tax residency. Okay. So that does conclude everything that I thought was important to go through today. The main points being tax treaties, tax treaties, tax treaties. Be aware of the 45-day threshold, because once you are in, it's going to be harder to get out. 45-day breach in year 1, it may cost you 3 years of Australian tax residency. So I hope that gives the expat community just some clarity on how these proposed rules may affect them if they come into effect and what the risk areas are. And I think with a degree of planning, these rules can be managed. And although they are strict, I do think things are going to be okay because we know what the rule's going to be. Okay. So happy to pass it back over to you, Jack, and happy to take any other questions.
Look, I mean, I'll start with a question on my own volition, and that is, why are they proposing these changes? Is there a particular reason that they're wanting to kind of tighten these rules and this legislation?
Yeah, so the reason is that the rules were built in 1930. So that was an era before there was common international travel. So Qantas actually took its first international passenger flight out of Australia in 1935. Okay, so 5 years after these rules came into effect. So you can imagine that the legislators of that era didn't have the forethought to think about what international living, working, travel arrangements would look like in 2021, where we have Australian expats and international travel and people basically living in multiple countries. So the consequence of that is over the last 90 years, we've had an absolute pile of common law stack all the relevant factors that we need to consider and wait. It comes to a point where, although they call it an objective test to determine residency, if it's not actually defined in legislation, one can only rely on subjective interpretation of both what the rules mean and what the facts are. So we get to a point where the rules just cannot be administered very effectively because of these international working and living arrangements. It gives taxpayers uncertainty as to their tax outcomes, and it gives taxpayers a burdensome compliance cost to make sure that they're complying under Australia's self-assessment system. International comparisons, these proposed rules, so the 45-day threshold, that is in line with the UK, and in fact New Zealand has a 40-day threshold. So it's very much standardized across the world, or at least for Commonwealth countries. So basically it's time for a refresh, Jack, is where we get to.
Fair enough. Look, we've got quite a few here, so I'll just pick out some of what I think will be the most relevant ones, and then we'll get back to the ones that we don't have a chance to via email after independently. So look, I'll start with Joe, who's just said that or proposed a question that if you arrived in the UAE in 2018 and haven't been to Australia for 3 years in FY23, do they count the commencement date as a non-resident from 2018 or from FY23?
Oh, FY23. That's right. So prior years' activities won't count at all.
Perfect. Denise has asked, are there any or are there likely to be any changes to any of the tax treaties following on from this, or are they completely independent issues to kind of discuss further after that?
Yeah, look, tax treaties, I don't think they'll change. That's a whole other political process that relates to trade agreements and a bunch of other political things. So I don't think that will be undertaken at all. It's going to be the case, I believe, that our tax laws will better incorporate the tax treaties. And that's certainly what the Board of Taxation is proposing.
And look, I know that we had a chat about this yesterday before we joined tonight, but Danusha just asked, would the government prescribe a consultation and feedback period for arguments against this proposed change?
Yeah, so that'll certainly be the case when the bill goes into Parliament. So the bill goes into Parliament, it'll have an explanation that follows it, and then all the members will gather feedback from their constituents and pass that feedback by their votes against or for the bill. And that is when the feedback happens. But having said that, the Board of Taxation through 2017 and 2019 consulted with immigration agents, tax advisors, expats directly themselves. So there's been collaboration also, but look, fully recognise that they're very strict, difficult rules, and they're a great change from where we are at the moment. So although there has been consultation, it's going to be a tough time to get used to.
Yeah.
Oh, sorry, Jack, you go.
Sorry, Michael, you can jump in.
I was just going to say just an interesting question from Ashan. Just asking around, the plans, or, with the new rules, are there plans to include disclosure of foreign income for non-tax treaty countries? So how would the Australian government actually know what someone was earning overseas? What obligations are there? Is it how does that actually work?
Yeah, and that's a good point. So look, I'm not sure what the data sharing agreements are. It's not instantaneous sort of data sharing. As tax agents, we can see what information the data collects on our clients, and the ATO doesn't collect any international income for us to include in a tax return at this point. However, it's not to say that there won't be a point in time where they backtrack and collect all historical information and do a data matching process. But look, I would expect something to be involved around that, but I couldn't give you a definitive answer on data matching or anything like that.
I've also got Daniel here who's just asked that if his employment contract ceases and he had to return to Australia for over 45 days before his new employment contract came into effect in a non-treaty country, how would that affect him?
Yeah, so if that's the case, it would have to be excluded by way of a special circumstance. And we just have to wait and see how that special circumstance is drafted into law. It may be a very broad and interpretative clause in the law, which we then have to go test and trial through the courts to find out what that means, or it might give us some very explicit circumstances where that would apply. So as to unexpected employment termination and so forth, not quite sure how that will apply just yet.
Perfect. And I think one last one from Bill that I've got here is, so if you relocate to a tax treaty country, example, the USA, what is the criteria to become a non-tax resident of Australia?
Very simple, set up a permanent home in the USA. So Australia has a tax treaty with the USA, and under the tax treaty, it says you'll be a resident where your permanent home is. If you have a permanent home in both or in neither, it's where your economic and social connections are closer. So assuming that you have only one permanent home in one of those countries, and that is the USA, that's what you need to do to break your Australian tax residency status.
Perfect. And look, I think I'll finish with one final question, and this is just from a conversation I had with a prospective client today, just especially around this. Hong Kong doesn't have a tax treaty with Australia, as we mentioned yesterday, but I guess due to the political nature with China, we do have a tax treaty with China. Are they treated completely separately, or is there some sort of ambiguity to that situation and scenario? Or?
Yeah. Are they now grouped, right? And I was interested in this topic a number of weeks ago, so I looked into it. There's been no guidance saying that they are considered as one, but in the meanwhile, since China has regained control, if that's the right terminology, of Hong Kong, Hong Kong has since entered into trade agreements with China. Now, the mutuality principle says that one cannot enter a contract with itself. So on that basis of Hong Kong still contracting with China, I would imagine that there's still very distinct jurisdictions for taxation.
It's right.
And I think just one last one from Lisa. When and you had mentioned this up front, Dean. So if you don't mind just recapping on when you think that, or we think that the proposed legislation could come into effect.
Yeah, so the government expects it to come into effect for FY23. The reason I say that, because in the budget papers, the government has to put forward their revenue projections about all the rule changes. And in these revenue projections, they have a quantum disclosed in FY23. So my interpretation is that they expect them to be enforced, these rules to be enforced by FY23. Now, the interesting point around this is the amount of tax revenue that the government expects to capture because of these rule changes is $1 million. That is it. Okay. They expect everyone to adjust their behaviors to suit them and not be caught. That's interesting. So it goes to the point that it's not a cash grab by government. It's been independently done by the Board of Taxation, and the government is doing these things prospectively with the full expectation that taxpayers will adjust their behaviors accordingly and won't get trapped in a bit of a tax minefield.
Amazing. Well, look, I think that's that's most of the questions that have come through. And as I mentioned before, if there are any further questions, we'll send this out afterwards as a recording. There'll be a direct link to Dean as well. I think Dean, you had a little final slide there that you wanted to potentially...
Yeah, that's right. I do have a shameless plug. Look, always here for a professional... That's right. Always here for a professional sounding board. So if you want to check your circumstances and have a conversation, inbound, outbound Australian individuals, certainly very happy to do that. If it gets to the point where you need formal tax advice, we have the capability to do that here as well at Stanford Brown. We do that for a lot of our clients. And our core business is lodging tax returns. So if you're an Australian expat and you need an Australian tax return lodged, we would love to help you with that as well. So thank you.
Amazing.
Yeah, thank you so much, Jack and Dean. It's been really informative.
Perfect. And like I said, to everyone that has tuned in tonight and to those that couldn't make it, I will endeavour to get this out within the next 24 hours. And then included in that will be a contact card for Dean. So feel free to contact Dean direct and discuss any further questions. And I'm more than positive Dean will be able to answer all those. So first and foremost, Dean, thank you so much for your time tonight. It is an incredibly complex issue. I've been dealing with it myself, dealing with a lot of the new client meetings. Michael's been dealing with some prior clients, and it's just a lot of confusion at the moment. And I think hopefully we've been able to alleviate a lot of that tonight. So yeah, thank you very much for not only joining us, but providing such in-depth detail and especially with the answers to some of the questions as well. Hopefully a lot of the attendees have gotten a lot out of it. And again, thank you very much for taking the time to do it.
Well, thank you for having me, and it's been my pleasure. Thank you, Jack. Thank you, everyone.
All right. Well, thank you, everyone. And again, this will be up and available within the next 24 hours. So keep an eye on your email and have a lovely morning, day, evening, wherever you may be. And we'll see you next month.
Thanks, guys.
Thank you.